In September 2008, the world watched in horror as Lehman Brothers vanished overnight. One of the biggest investment banks on the planet gone. The stock market plunged. Credit markets froze. People lined up outside banks in Britain, in America, in Europe, terrified they would never see their savings again. Central banks and governments threw everything they had at the fire. The final bill to stop total collapse? $29 trillion in bailouts, loans, guarantees, and printed money, almost twice the size of the entire US economy at the time. And it barely worked. Most people think we fixed the problem. We didn't. We made it 10 times bigger. Back in 2008, the global derivatives market stood at roughly $600 trillion in notional value. Today, at the end of 2025, it is over $1 quadrillion. Some estimates from the BIS and the OCC now put the true figure closer to 1.2 quadrillion when you include unreported and shadow positions. That is not a typo. $1 quadrillion, $200 trillion of bets stacked on bets, leveraged on leverage, hidden in the footnotes of the biggest banks on earth. Think about that for a second. Global GDP, every good and service produced by 8 billion human beings in an entire year, is roughly $110 trillion. The derivatives market is now more than 10 times the size of the real economy. 10 times. In 2008, it was only 6 times. We didn't disarm the bomb. We strapped rocket boosters to it. And here's the part nobody wants to say out loud. There is no longer enough money on the planet to bail this thing out when, not if, it blows. In 2008, the losses that threatened to wipe out the system were ultimately contained to a few tens of trillions. Central banks printed, governments guaranteed, and taxpayers footed the bill. Next time the whole will be measured in hundreds of trillions. There is no printing press big enough. There are no taxpayers rich enough. There is no combination of IMF, Federal Reserve, ECB, Bank of England, and People's Bank of China that can write a check large enough to fill a quadrillion-dollar black hole. This is no longer a financial crisis waiting to happen. It is a mathematical certainty. Let me show you exactly why this time really is different, and why the escape hatch that saved the world in 2008 has been welded shut. First, understand what changed. After 2008, politicians swore they would never let the banks become too big to fail again. They lied. The top 5 US banks now control almost 50% of all banking assets. In America, being more concentrated than before the crisis. Their derivative books are monstrous. JPMorgan, Chase alone carries $54 trillion in notional derivative exposure. Citibank, $48 trillion. Bank of America, $37 trillion. Goldman Sachs and Morgan Stanley, another $90 trillion combined. 4 Wall Street giants, 4 balance sheets, nearly $200 trillion of notional bets between them. Their combined capital, the actual money they could lose before becoming insolvent, is less than $800 billion. That's 250 to 1 leverage on paper. In a real crisis, the hedges fail and it becomes gross exposure. Game over. Second, the composition of the monster has changed. Over 80% of the quadrillion is now interest rate derivatives, swaps, swaptions, caps, floors, and exotic structures no human being fully understands. These contracts were priced and hedged, assuming interest rates would stay near zero forever. They didn't. The fastest hiking cycle in 40 years. Ripped through the system from 2022 to 2024, and the losses are already sitting there, buried under held-to-maturity accounting tricks and regulatory forbearance. Banks are not marking hundreds of trillions to market because if they did, half of them would be insolvent tomorrow morning. Third, the clearinghouse myth has been exposed. Politicians told us moving derivatives onto central clearing houses would eliminate counterparty risk. It didn't. Only the plain vanilla stuff is cleared. The truly toxic, bespoke, multi-layered monsters, the ones that actually kill you, are still bilateral, over-the-counter contracts. When a major player defaults, the clearing houses themselves become the single point of failure. And guess who backstops the clearing houses in a crisis? The same central banks that are already out of ammunition. Fourth, the ammunition is gone. In 2008, the Federal Reserve balance sheet was $800 billion. Today it is still over 7 trillion and climbing. The ECB, Bank of England, Bank of Japan, every major central bank is already stuffed to the gills with government bonds and mortgage garbage. They cannot expand their balance sheets another 10 or 20 times without destroying their own currencies. Hyperinflation or total collapse. Those are the only two options left if they try the 2008 playbook again. Fifth, the political will has vanished. In 2008, the public was angry, but still believed the system could be saved. After 15 years of money printing, bailouts for billionaires, and cost of living hell for everyone else, that social contract is shredded. Try telling a British nurse or an American truck driver in 2026 that another 30 trillion must be found to rescue Deutsche Bank's derivative book. They will burn the building down before they write the check. Sixth, the triggers are already flashing red. Commercial real estate is imploding. Corporate debt stands at record highs issued at near zero rates that no longer exist. Sovereign debt in Europe, Japan, and even the United States is at levels that made Greece collapse in 2010. One major default cascade, one large hedge fund, one European bank, one over-leveraged pension fund, and the margin calls start. Collateral vanishes. Liquidity dries up. The quadrillion-dollar daisy chain begins to snap, link by link. When that happens, the sequence will be brutal and lightning fast. Day 1, a major player misses a variation margin call. Day 2, forced unwinds flood the market. Prices gap 20, 30, 50% in hours. Day 3, clearing houses demand extra collateral no one has. Day 5, governments try emergency liquidity lines that get swallowed instantly. Day 10, ATM networks go down, payment systems freeze, supermarkets run out of cash. Within 2 weeks, the entire global financial system is on its knees, begging for mercy that cannot come. And this time there will be no cavalry riding over the hill with $29 trillion, because 29 trillion is pocket change now. The whole will be measured in hundreds of trillions, and the world's total stock of base money across all major currencies is less than 30 trillion. Do the math. It doesn't add up. This is not fear-mongering. This is arithmetic. The banks know it. The regulators know it. The central bankers whisper it to each other in Basel corridors while publicly insisting everything is fine. They have no plan beyond pray and delay. Negative interest rates won't work. Yield curve control will collapse under its own weight. CBDCs and capital controls will be rolled out after the damage is done, not before. There is only one question left: when, not if. The quadrillion-dollar doomsday machine is already ticking. Every basis point move in interest rates, every default in a zombie company, every geopolitical shock brings us closer to 0 hour. When it detonates, the blast will make 2008 look like a mild recession. In 2008, they found $29 trillion to save the system. Next time, there isn't 290 trillion. There isn't even 50 trillion. There is nothing but the cold realization that the era of endless bailouts is over. The bill for 40 years of leveraged greed is finally coming due. And this time the world is broke.